Hello and welcome to this Basic Macroeconomics Revision Course. I am your teacher Nadeem Sarwar. Today we shall discuss GDP and the methods of measuring GDP. This is our second lecture. The reference books for today's lecture are Macroeconomics by Robert J. Gordon, Macroeconomics by Oliver Blanchard, and Macroeconomics Theories and Policies by Richard T. Freund. Let's start with the lecture. Students, national income accounts are used to measure aggregate economic activity of an economy during a given period of time. The aggregate output, that is, the total output produced by all the sectors of an economy within a specific time period, is measured by GDP or gross domestic product in national income accounts. The GDP can be defined and measured in three ways. One, the product method. Second, the income method. And the third is expenditure method. Today, we shall go through all these three methods in detail. First is product method. In this method, we add up the values of all commodities produced in an economy during the given specific time interval. We use commonly known definition of GDP, that is, it is the market value of all the goods and services produced in an economy during a given period of time. The GDP in product method can be measured by two ways. First is final good approach and second is value added approach. In final good approach, we only take market value of final goods while measuring GDP, and the value of intermediate goods are not counted separately in GDP. Students, a final good is one that is meant for final consumption. For example, bread, shirts, pants, etc. While an intermediate good is a good that is used to produce other goods. For example, wheat is used to produce bread. Cloths, threads, and buttons are used to produce shirts, etc. Students, since the price of final good, like car, includes the values of all intermediate goods such as tires and airbags, etc. So, counting the value of intermediate goods separately will result in double counting and thus overstating GDP. Similarly, for capital goods, which include plants and machineries, as these goods last for long and produce goods over many years, so only a fraction of their value is used up in production. This fraction is called depreciation, and its value is also included in the price of final good. There are three major rules of including items in total final product. First, currently produced. The good must be currently produced. Therefore, we exclude all used items. It also excludes financial transactions such as sale and purchase of bonds. Also, any transaction in which money is transferred without any accompanying good or a service, that is transfer payments. Similarly, it also excludes capital gains accruing to person as the price of their asset change. We exclude all these because all these transactions are not against newly produced goods. It is also important to note that income, fee, and commissions earned by used goods sellers, property dealers, or financial service providers are included in GDP. Can you answer why this is so? Dear listeners, as these goods or properties are not currently produced, their price is not included in GDP. But the fee or commission charged by the agents is included in the GDP because the services of these agents are currently produced. The second rule is that we only include goods that are sold in the market at market prices. This enables us to add different kinds of goods such as apples with roads and computers, etc., because we convert the value of these goods in monetary terms and thus add them. However, this excludes self-consumption, that is, the value of personal time spent in activities that are not sold in the market. Similarly, it also excludes pollution cost allowances and income from any illegal activity. It is also important to note that as the value of goods and services are evaluated at market prices, which keep on changing, therefore, GDP may increase or decrease only because of change in prices. Such GDP is called nominal GDP, and to correct this, we use real GDP. This was discussed in detail in lecture 1. The third rule is that the goods must not be resold. That is, we only include those goods which are being sold first time. Second approach is value added approach. We can also define GDP as the sum of value added in the economy during a given time period, where value added is the net of the value of a firm's production we subtract the value of intermediate goods used in the production. I repeat, the value added is equal to the value of firm's production minus the value of intermediate goods used in the production. We discuss both of these approaches with a simple example. We know that to produce a book, the publisher needs papers which are produced by woods and leaves. Let us assume that a person collected woods and leaves worth rupees 50, converted them into papers worth rupees 125 and finally converted them into a book worth rupees 500. Now, under final good approach, we should include in GDP only the price of final good, that is the book, which is 500, and ignore the intermediate goods such as paper, wood and leaves. However, from value added approach, we look at the addition in value at each stage. At wood and leaves, the addition was of rupees 50. When they were converted into the papers, the addition in the value was rupees 75. And when the paper were converted into books, the addition in value was rupees 375. So adding 50, 75 and 375, we get same answer as 500. The second method of measuring GDP is income method. Students, GDP is also defined as the sum of incomes earned by all the people living in a country in a specific time period. People earn income by providing factors of production like land, labor, capital, and entrepreneur. Therefore, the GDP is equal to the sum of rental payments, wages, interest payments, and profits earned. In this example, we show the GDP of England and Wales in million of pounds. The wages and salaries worth 17.7 million pounds, rents were worth 13 million pounds, profit and interest accumulatively worth rupees 14.7 million pounds, and other miscellaneous kinds of income were worth rupees 2.6 million pounds. Adding all of them, we get 48, which is our national income or GDP. The third measure of GDP is expenditure method. We can define GDP as the sum of expenditures made on purchasing final goods and services during a specific time period. Expenditures made by different economic agents can be classified as consumption expenditure, investment expenditure, government expenditures, and net exports, which are the expenditures of foreigners on the purchase of our produced commodities. So adding up all the expenditures gives us the value of GDP. Students, expenditures equal income because every unit of money spent by a buyer becomes income of the seller. Therefore, now we discuss these components of expenditures one by one. First is consumption, which is defined as the expenditures of households on all the goods and services bought for personal use and to enjoy their utility. It includes consumption of durable goods which last a long period of time. For example, cars and home appliances. The consumption of non-durable goods which last a short time period, for example, food and clothes, and the consumption of services, which is the work done for the consumer, for example, dry cleaning and air travel. Students, consumption is the largest part of national income, which is normally more than 80% of the total GDP. Second component is investment. Investment is the spending on the goods bought for earning income. We can also define investment as the expenditure on increasing capital stock. The investment includes business fixed investment, which includes all final goods and services, especially structures and equipments purchased by businesses not intended for resale. Residential fixed investment, which is the spending by consumers and landlords on housing units. And inventory investment, which is the change in the stock of raw material, parts, or finished products held by businesses. In simple words, any goods that are unsold are automatically counted as a part of unplanned inventory investment. These three, business fixed investment, residential fixed investment, and inventory investment, make up the total of investment. Students, there is an interesting relation between investment and saving. Personal saving is the part of personal income that is not consumed or not paid out in taxes to government. Algebraically, this is Y is income, T are the taxes, and C is the consumption. Funds from saving are channeled to firms in two basic ways. First, households buy bonds and stocks issued by the firms. This transfers the savings of households to firms, which use them to enhance their production activities and increase future income. The second is households deposit savings in banks and other financial institutions, which in turn lend money to firms to enhance their production process and earn more income. For this, we can say that saving is a leakage from the income used for consumption expenditures. This leakage is normally balanced by an injection on non-consumption spending in form of private investment. Next component of expenditures is government spending or government expenditures, which is the value of goods and services purchased by the government. There is another term which we should also understand, which is transfer payments. These are the payments made by the government to the households against no services provided from the households. That is, these are the payments that are made to the households without acquiring their services. For example, social security payments, medical care, and food stamps. Students, the government expenditures include the government purchases only, and government finances these spendings by collecting taxes or by borrowing or by printing money. If the amount of taxes collected is greater than government expenditures. We refer this situation as budget surplus. However, if the amount of tax collected is less than expenditure, this is referred as budget deficit, and the equality of the two is termed as budget balance. The final part of expenditures is net export. Students, exports are the goods produced within one country and shipped to another. Exports create income in the producer country, but not the part of consumption and investment spendings of residents. On the other hand, imports are the goods consumed within one country but produced in some other country. These are the expenditures of residents for the goods and services which were produced abroad and thus do not create domestic income. If for an economy the value of exports is greater than the value of imports, this is termed as trade surplus. The opposite of it is called trade deficit. And if value of exports is equal to the value of imports, this situation is referred as trade balance. If there is a trade surplus, the net effect of the trade is a higher level of domestic production and income. Let's study the link between net exports and net foreign investment. Students, net exports is the other name of net foreign investment. Since net foreign investment creates claims on foreigners. Like if Japan exports to US are greater than its import from US, the US payments of net export will enable Japan to buy US assets, including bank accounts in USA. Therefore, net foreign investment is equal to the purchase of foreign financial assets minus foreign purchases from financial assets. Therefore, net export are equal to net foreign investment. This example shows the United States national accounts in 2001 measured through expenditure approach. Adding up the value of consumption expenditures, which is 10729, investment expenditures, which is 1855, government expenditures, which is 3060, and net exports, which is minus 568, we can get the total GDP, which is 15076. Students, we can measure the GDP of our country through any of these three methods. All these three methods, that is the product, the income, and the expenditure approaches, give the same answer, and it is not an accident. The logic of that these three approaches give same answer are: number 1, observe that the market value of goods and services produced in a given time period is by definition equal to the amount that buyers must spend to purchase them. So, the product approach, which measures the market value of goods produced, and the expenditure approach, which measures the spendings, must give the same measure of economic activity. Second, observe that what seller receives must equal to what buyers spend, and the seller's receipts in turn are divided into incomes paid to the workers and suppliers, taxes paid to the government, and the profits, which are the incomes left over. All these three incomes, that is the income of workers, suppliers, governments, and entrepreneurs. Thus, total expenditures must also equal to total income generated. Therefore, all these three approaches give us same values. That is all for this lecture. In the next lecture, we shall discuss the circular flow of national income among different economic agents through various markets, and we shall discuss different concepts of national income other than GDP. Please post your questions and give your feedback in comments. Also consider liking and sharing the video and subscribing the channel.